You land in Bali. Palm trees, surf, coconut water. A villa owner says, "Send me USDT and I'll give you a discount." You think it's a great deal. Everyone thinks it's a great deal. But what you don't know could get you deported from Indonesia. Not next year. This week, BAPPEBTI, OJK, the Directorate General of Taxes, and Bank Indonesia are now tracking every crypto wallet movement. There are 7 legal traps that 90% of foreigners in Bali don't even know exist. And the new regulation, PMK 50, effective August 1st, 2025, has completely rewritten the rules of crypto taxation. But here's what they don't tell you. Indonesia's crypto market is $1.5 billion US, with over 20 million active users and 229 plus cryptocurrencies officially recognized by BAPPEBTI. The government has classified crypto as a digital financial asset, not a currency, not a commodity anymore, but a legitimate asset class. And there is a fully legal, fully compliant way for PMAs, foreign companies, and institutional investors to participate in this market through BAPPEBTI registered and OJK supervised digital asset platforms. In the next 25 minutes, I'm going to show you how stablecoins actually work and how to use them to protect your balance sheet from FX volatility. The 7 legal traps in Bali that can destroy your business overnight. The PMK 50 tax revolution. VAT eliminated, income tax simplified. How to set up a PMA for digital asset operations in Indonesia. And finally, how Sungazer helps PMAs and foreign entities legally onboard to Indonesia's regulated digital asset ecosystem. Let's dive in. Before we talk about Indonesia's crypto ecosystem, we need to understand the asset that powers 80% of on-chain trading in this country: stablecoins. According to a comprehensive report by J.P. Morgan Private Bank published in October 2025, stablecoins are a type of cryptocurrency designed to peg against a specific asset, typically the US dollar. They combine the speed and programmability of crypto with the stability of fiat currency. The market has exploded from just $3 billion in total market capitalization in 2019 to over $230 billion by Q2 2025. That's 76 times growth in 6 years. 2 players dominate: Tether, USDT, with roughly 2/3 of market share, and USD Coin, USDC, Circle's highly regulated stablecoin that had its IPO in June 2025, with shares rallying over 700% at peak. There are 3 ways stablecoins maintain their peg, and understanding this is critical before you put a single dollar into any of them. Type 1. Fiat collateralized, the safest. Backed 1-to-1 by cash and cash-equivalent reserves. USDT and USDC are the prime examples. The issuer actually holds the dollars in a bank account or U.S. Treasury bills. Type 2. Crypto collateralized, backed by other crypto assets, like DAI, which is backed by Ethereum. Because the backing assets are volatile, they must be over-collateralized. You deposit more ETH than the DAI you mint. If the collateral falls below a threshold, it gets liquidated. Type 3. Algorithmic. No collateral at all, just code. The most famous example was Terra USD, UST, an algorithmic stablecoin that collapsed in May 2022, wiping out over $40 billion in value. The Luna token went to zero. Thousands of investors lost everything. The lesson? Fiat collateralized is the gold standard for institutional use. If you're a PMA holding working capital in stablecoins, you want USDT or USDC, not a speculative algorithmic experiment.
Some people say stablecoins are, quote, just like a currency peg. Let's test that assumption. The Hong Kong dollar has maintained its peg to the US dollar through the 1997 Asian financial crisis, the 2008 global financial crisis, 2019 social unrest, and COVID. It's one of the most successful currency pegs in history. Now, let's compare USDT to the Hong Kong dollar. Peg Manager. Tether is a for-profit private company. The HKMA, Hong Kong's monetary authority, is the de facto central bank, a not-for-profit regulator. Backing ratio. USDT holds approximately 103% reserves, about 3% excess. The HKD maintains between 105 and 112.5%, currently at 111.5. Backing assets. USDT holds roughly 80% in cash and equivalents. The rest includes secured loans, Bitcoin, and gold. The HKD holds only high-quality, highly liquid USD-denominated assets in a fully segregated portfolio. Transparency. Tether publishes quarterly attestations by BDO. The HKMA offers full public disclosure, daily operations, monthly backing details. Regulatory framework. USDT operates in a largely unregulated space. The Genius Act is still pending in the United States. The HKD sits under a strong regulatory framework established by Hong Kong's Exchange Fund Ordinance. The difference is clear. A government-backed currency peg with a century of institutional credibility versus a private company's quarterly attestation. This doesn't mean USDT is unsafe, but it means you need to understand the structural risks before allocating corporate capital. Historically, all major stablecoins have experienced price fluctuations. Let me give you the timeline. March 2020. The ETH crash sent shockwaves through the market. DAI, a crypto-collateralized stablecoin, briefly traded at a premium above $1, a sign of stress in the system. May 2022. The Terra/Luna collapse. An algorithmic stablecoin with no real collateral, just code, suffered total failure. Over $40 billion in value was wiped out in a matter of days. The Luna collapse remains the largest single destruction of value in crypto history. March 2023, the Silicon Valley Bank crisis. USDC, considered one of the safest stablecoins, broke its peg. It dropped to 87 cents. DAI fell to the low 80s, exposed through its peg stability module. Both recovered within 24 hours. But the scare was very real. And in 2021, the CFTC fined Tether $41 million for alleged misstatements about its reserves, covering a period from 2016 to 2018. What drives these depegging events? 5 root causes: confidence impairment from crypto or banking risk spillovers, hacks and security breaches, fiat rail issues that slow redemptions, on-chain liquidity imbalances, and market structure frictions that amplify volatility at the worst possible moments. JP Morgan identifies 2 structural risks every institutional investor must understand. Risk number 1, conflict of interest. Stablecoin issuers are for-profit companies. There is a structural temptation to seek higher financial returns in the backing portfolio. Shareholders capture the upside. Token holders absorb the downside. Any shift toward non-cash equivalent assets, longer duration treasuries, lower quality credits, or directional bets, introduces risk. If redemption requests surge and the issuer cannot liquidate fast enough, the peg breaks. Risk number 2, duration risk. Right now, high interest rates allow stablecoin issuers to earn over 4% on reserves. But the Federal Reserve is expected to cut rates. That squeezes profitability. And when profitability is squeezed, the temptation to chase yield intensifies, which brings us right back to risk number 1. Tether alone holds over $127 billion in US Treasury securities as of Q2 2025. The entire stablecoin ecosystem holds roughly $200 billion in T-bills, approximately 3% of the total $6.2 trillion T-bill market. Now let's get practical. How can PT, PMAs, and foreign companies actually use stablecoins? Use case number 1, cross-border payments. Stablecoins enable around-the-clock settlement with minute-level latency and dramatically lower fees. Think, digital dollars you can send 24/7 to anywhere in the world, instantly, without a correspondent bank, without a 3-day SWIFT delay. Indonesia received $10.73 billion in remittances in 2024, up 4.1% year-on-year. Blockchain-based services could save up to $300 million annually in remittance costs. For a PT PMA paying overseas suppliers or receiving international payments, stablecoin settlement is faster, cheaper, and more flexible than traditional banking. Use case number 2, treasury management and operational hedging. This is the big one, especially for anyone holding IDR-denominated working capital. According to Yellow Card's January 2026 analysis, Q1 is historically the most volatile quarter for emerging market currencies. Import demand surges while export revenues lag, creating predictable downward pressure on the rupiah every year. Traditional hedging, often impossible. IMF research shows FX derivatives markets in most emerging economies are non-existent or illiquid. Where they exist, bid-ask spreads exceed 200 to 300 basis points, making hedging prohibitively expensive for most companies. Enter stablecoins as an operational hedge. Instead of buying expensive derivatives, treasurers simply hold a portion of working capital in USD-denominated stablecoins. The mechanics are straightforward. Convert excess IDR to USDT or USDC during stable periods. Hold in yield-generating accounts earning 4 to 6% annually, backed by short-term US Treasury securities. Convert back to IDR on demand for operational needs, and maintain a natural hedge against IDR devaluation. The math is compelling. For a PT PMA managing $10 million in working capital, that's $600,000 to $900,000 in annual value creation. Use case number 3, tokenization and capital markets. This is where stablecoins meet the future of institutional finance. Stablecoins serve as the cash leg for on-chain securities. They enable atomic delivery versus payment settlement, the asset and the payment exchange simultaneously in a single transaction with zero counterparty risk. No T+2 settlement, no failed trades, no clearinghouse delays. Traditional players, banks, brokers, asset managers are already integrating blockchain technology. Tokenized deposits, tokenized mutual funds, real-world assets on-chain securities. This is not a future concept, it is happening right now, and stablecoins are the settlement layer that makes it all work. Now let's talk about the country you're actually in, Indonesia. The Indonesia cryptocurrency market is valued at $1.5 billion based on 5-year historical analysis, 20 million active users, 229 cryptocurrencies officially recognized by BAPI-BTI. Jakarta and Bali are the two epicenters. Jakarta as the financial and fintech hub, Bali as the digital nomad and tech entrepreneur magnet. The competitive landscape includes major local exchanges, Toka Crypto, Indodax, Pintu, and Luno Indonesia, alongside international players like Binance Indonesia, Kraken, OKX, and Bitfinex, all of them operating within Indonesia's BAPI-BTI regulated framework. Bank Indonesia is launching the digital rupiah, a central bank digital currency, under what they call Project Garuda. Being developed in 3 phases: wholesale functions first, then retail functions, then full integration. This tells you something important. The Indonesian government is not anti-digital asset. They are pro-innovation. but within a regulated framework. The infrastructure is being built from the top down, and that creates a significant opportunity for foreign companies that are properly positioned within that framework. And beyond Project Garuda, Indonesia's crypto market is growing fast. The competitive landscape is maturing, and the regulatory infrastructure is being built to support it. Here's the most critical section of this entire video. Every foreigner in Indonesia needs to understand this, whether you're a tourist, a digital nomad, or running a company. According to Indonesian law, Undang-Undang No. 7 of 2011, only the Indonesian rupiah is recognized as legal tender. Crypto in Indonesia is classified as a commodity, not a currency. It is regulated by BAPI-BTI, the Commodity Futures Trading Regulatory Agency. With the passage of Law No. 4 of 2023, crypto assets have been reclassified as digital financial assets. And PMK 50, effective August 1, 2025, finally aligned the tax system with this new classification. What is legal? Buying, selling, and trading crypto on BAPI-BTI registered exchanges, holding crypto as an investment asset, converting crypto to rupiah through licensed platforms. What is illegal? Using crypto to pay for goods or services, accepting crypto payments as a business. Advertising, crypto accepted here. Processing transactions in any currency other than rupiah. Bank Indonesia mandates all digital payments through QRIS, which does not support cryptocurrency transactions. I'm going to name all 7 legal traps. If you're doing business in Bali or planning to, save this section. Trap number 1. Accepting crypto as payment is illegal. Any transaction in Bitcoin, Ethereum, or USDT for payment puts your business at risk of fines or operational shutdowns. Indonesia's law is clear. Only rupiah. Trap number 2. Quitus revocation or deportation. If immigration authorities find out you're running a foreign-owned business accepting crypto payments, your quitas can be revoked. You can be deported. These are not hypotheticals. Trap number 3. Tax reporting complexity. Crypto earnings are not easily reportable unless converted to rupiah and declared. Failure to report means audits, back taxes, and penalties. Trap number 4. The shadow economy. Operating informally, even with a registered business, carries risks of tax evasion implications, scrutiny for working illegally, and zero legal protection if something goes wrong. Trap number 5. Scams and fraud. Tourists tricked into paying for non-existent villas in USDT, phishing schemes, rug pulls, counterfeit wallet addresses. Once the crypto is sent, it's gone. There is no chargeback. Trap number 6. Government surveillance. The Ministry of Finance and OJK now monitor bank deposits and crypto wallet movements closely. Banks flag unusual inflows that don't match declared income. Tax authorities are cross-referencing data. Trap number 7. AML and financial compliance violations. Unregistered crypto activity can be flagged as money laundering or violating Indonesia's anti-money laundering framework. The consequences can be severe. The legal way to handle crypto in Bali. Use only BAPI-BTI registered exchanges. Keep crypto dealings completely separate from your business operations. Register your tax status. Obtain an MPWP. And work with regulated facilitators who understand the full compliance landscape. That's how you stay in Indonesia. That's how you build a legitimate, durable business here. Effective August 1, 2025, Indonesia's Minister of Finance issued Regulation No. 50 of 2025, known as PMK 50, and it completely rewrites crypto taxation in Indonesia. 3 big changes. Change number 1. VAT eliminated on crypto asset transactions. Because crypto is now classified as a digital financial asset, akin to securities, the delivery of crypto assets is no longer subject to VAT. However, VAT at 12% still applies to platform services, buying and selling crypto with fiat, crypto-to-crypto exchanges, and e-wallet services. Change number 2, final income tax, 0.21% for domestic transactions, 1% for foreign. Income received by crypto sellers is now subject to a final income tax of 0.21% when conducted through domestic BAPI registered platforms. For transactions through foreign platforms without an appointed tax collector, the rate is 1%, intentionally higher to incentivize traders to use regulated domestic platforms. Change number 3, multi-agency governance. PMK50 establishes coordination among 3 institutions: DJP, the Directorate General of Taxes, for fiscal compliance; OJK, the Financial Services Authority, for investor protection and systemic stability; and BAPI for supervision of crypto exchanges and trading platforms. This is a mature regulatory framework. It signals that Indonesia is serious about integrating digital assets into its financial mainstream. A quick note for crypto miners. Under PMK50, crypto miners must collect VAT on transaction verification services using a special formula, 20% multiplied by 11/12, multiplied by the standard VAT rate of 12%, multiplied by the crypto asset value at the time of the transaction. Additionally, the Article 22 income tax that previously applied to miners at 0.1% has now been removed. Mining income is now subject to regular income tax under Article 17 of the Income Tax Law, starting in the 2026 tax year. If you are operating a crypto mining business in Indonesia, this change materially affects your tax structure. Get proper legal and tax advice before you file. If you're serious about doing business in Indonesia's digital asset space, whether you're a crypto fund, a fintech company, or a blockchain startup, you need a PMA. That stands for Perseroan Terbatas Penanaman Modal Asing, a foreign-owned limited liability company. It is the legal entity through which foreign investors can conduct commercial activities in Indonesia, including in the digital asset sector. 2 critical questions before you start. First, PMA or representative office. If you plan to generate revenue and profit in Indonesia, you need a PMA. If you're simply exploring opportunities, conducting market research, or networking, a representative office, or KPPA, may be sufficient. Second, is your sector open to foreign investment? Check the negative investment list compiled by BKPM, Indonesia's Investment Coordinating Board. If your sector is partially closed to foreign investment, the list will state the maximum percentage of foreign ownership allowed. In that case, you'll need a local Indonesian partner. The minimum requirements: a minimum investment commitment, at least 2 shareholders, one of which can be a foreign entity, a minimum of 1 director and 1 commissioner, and a registered office address in Indonesia. In practice, many PMAs are established with shareholders signing a capital statement letter pledging that capital can be transferred, without necessarily transferring it immediately. However, for capital-intensive sectors including digital finance, proper capitalization is critical for licensing. The full PMA establishment process takes approximately 10 weeks and costs around $3,000, depending on the sector and complexity of your business activities. Most foreign investors choose to work with specialized local companies to handle all procedures at BKPM and other relevant institutions. You simply send your documents. They handle the filings, the approvals, and the coordination. Important: additional licenses may be required for specific sectors. For digital asset operations, BAPI registration or OJK licensing may be required on top of the basic PMA structure. Always seek qualified legal advice before engaging in any investment activity in Indonesia. So after all of this, the legal traps, the tax changes, the complexity of setting up a PT-PMA, the question becomes, how does a foreign company or PT-PMA legally trade, convert, and manage digital assets in Indonesia without stepping into any of these legal landmines? The answer, Sungazer. We are not a money changer. We are not a P2P marketplace. Sungazer is an aggregator of BAPEBTI-registered and OJK-supervised digital asset platforms in Indonesia. We connect PT-PMAs, foreign companies, and institutional clients to Indonesia's regulated crypto ecosystem. 3 core services. First, PT-PMA digital asset onboarding. We help foreign companies and PT-PMAs legally access Indonesia's BAPEBTI regulated crypto exchanges, from initial registration and KYC to ongoing compliance and transaction support. Second, institutional-grade stablecoin management. Need to hedge IDR exposure. Convert working capital to USDT or USDC through regulated channels. We facilitate stablecoin transactions through Indonesia's licensed platforms. Third, regulatory compliance support. PMK 50, BAPEBTI guidelines, OJK regulations, tax reporting. We help ensure your digital asset activities are aligned with Indonesia's evolving legal framework. No surprises, no legal landmines. And to be absolutely clear, we are not a money changer. We are a compliant digital asset service facilitator operating within Indonesia's regulated financial ecosystem. We do not process crypto payments. That's illegal. We do not facilitate unregistered P2P trading. We do not operate outside BAPEBTI and OJK frameworks. What we do, connect PT-PMAs and foreign companies to Indonesia's regulated digital asset platforms. Facilitate compliant stablecoin transactions through licensed channels. And provide institutional support for digital asset treasury management. Why work with us? We are based in Kuta, Bali, just 5 minutes walking distance from Ngurah Rai International Airport. Our office is permanent. Our operations are transparent. We are part of Indonesia's regulated digital asset ecosystem. That proximity to the airport is not a coincidence. It means we are accessible to every foreign investor, every PT-PMA director, every institutional client who lands in Bali and needs to get their digital asset operations structured, immediately, correctly, and legally.
Last quarter, a foreign-owned fintech company approached us. They had just set up their PT-PMA, wanted to allocate part of their working capital into USDT for treasury management. But every article they read said crypto is risky in Indonesia. Every lawyer warned them about the 7 legal traps. They came to our office in Kuta, 5 minutes from the airport, right after their flight landed. We sat down. We explained the regulatory framework. We showed them how PMK 50 actually makes crypto taxation clearer, not harder. We introduced them to Indonesia's BAPEBTI regulated exchange ecosystem. Within 1 week, their PT-PMA was fully onboarded to regulated digital asset platforms. Within 2 weeks, they had their first compliant stablecoin transaction, documented and tax compliant. No shadow economy, no gray zones, full regulatory compliance. That's what we do. Indonesia's crypto market is $1.5 billion and growing. The regulatory framework is maturing. PMK 50 has given us clarity. BAPEBTI has recognized 229 cryptocurrencies. OJK is providing investor protection. The infrastructure is ready. The question is, are you? Sungazer, your bridge to Indonesia's regulated digital asset ecosystem. Visit us in Bali. let's talk about how we can help your PMA or foreign company legally onboard to Indonesia's digital asset ecosystem. Sungazer. Trusted, compliant, regulated.